It's Monday, 1st of December 2025. Welcome back to your news update on Blip Brief, crisp, but almost everything updated every weekday. We are diving straight into, well, a fascinating and complicated mess facing the Reserve Bank of India's Monetary Policy Committee this week.
It's a genuine economic head-scratcher.
Right. For the policymakers, this isn't just another meeting. The data points are practically at war with each other.
They absolutely are. It's like you're looking at two completely different economies at the same time. On one hand, you've got this spectacular growth. GDP surged 8.2% last quarter.
And that's the highest in 6 quarters, right?
Exactly. It completely blows past the RBI's own forecast of 7.0%. That kind of momentum, it usually screams, hey, the economy's running hot. Watch out for inflation.
So the textbook answer should be to hold rates, maybe even tighten things up a bit to stop prices from overheating.
Precisely. But here's the massive contradiction. Monthly inflation, it's sitting at a record low.
A record low.
And low inflation is the textbook reason to do the exact opposite, to ease policy, to cut rates, to stimulate demand. So the MPC is standing at this fork in the road.
So if they follow the inflation data, they cut. If they follow the growth data, they hold. What are the analysts saying? Which path are they likely to take?
The consensus is leaning towards caution, which makes a rate cut a really tough call. The thing is, central banks, they try to look beyond a single month's data, especially when growth is this strong. If they cut now, they could be seen as just reacting to a temporary dip in inflation.
And that could hurt their credibility long term.
It could. Plus, that 8.2% growth figure, it gives them all the cover they need to stay hawkish, to prioritize stability over a little extra stimulus.
Okay, so stability trumps stimulus for now.
Yeah.
Meanwhile, consumers are about to face some very definite price increases on a couple of fronts, starting with tobacco.
That's right. We're about to see new levies on cigarettes, pan masala, gutka. This is coming right after the GST compensation cess framework ended, and the government is clearly looking to plug that revenue gap with traditional sin taxes.
And this next one is a shocker. If you're flying out of the country's 2 biggest cities, your ticket price could be about to change dramatically.
Oh, this is a major regulatory bombshell. The user fees at Delhi and Mumbai airports, we're talking about a potential surge of up to 22 times their current rates.
22 times. That number is just... It's almost hard to believe. Can you unpack that? What is this fee even for, and why is a telecom tribunal making the call?
It sounds strange, doesn't it? But the fee is for things like modernization and maintenance of airport facilities. And TDST, the Telecom Tribunal, it has this kind of quasi-judicial role over tariff setting in some public services.
So they just sided with the airport operators?
Essentially, yes. They approved the fee structure the operators wanted, and that cost is a direct pass-through, which means you, the passenger, are going to feel it. It's a huge deal for the whole aviation sector.
Okay, from a macro headache to the markets, which seem blissfully unaware of any of this. Indian indices just hit new record highs for the 3rd week in a row.
The bullish feeling is just relentless. It's all underpinned by those strong domestic growth numbers we were just talking about. Even the opening signal this morning from the Gift Nifty, it's pointing to an upside of about 0.5%.
And it sounds like analysts don't think this is just a temporary peak.
Not at all. The targets they're setting are ambitious, somewhere in the 26,500 to 26,800 range for the Nifty. And what's giving them confidence is how broad this rally is. It's the big players, banks, auto, infrastructure, financials.
But hold on, if the indices are at a record, we have to talk about this weird paradox with foreign money. Foreign portfolio investors, FPIs, they were actually net sellers in November, right? Pulling capital out of existing stocks.
That is the catch. They were selling older shares, but they were not leaving India. They just showed this massive preference for the primary market. FPIs poured about $1.3 billion into IPOs.
And this has been going on for a while.
5th straight month. This is a clear, established pattern now.
So what's the logic? Why dump established stocks but go all in on new listings? Especially when the global mood is a bit risk-off.
Well, when global sentiment gets shaky, foreign capital gets very, very picky. They see these new IPOs as, cleaner growth stories, often less legacy debt, a clearer narrative. They're hunting for pristine balance sheets, and new listings often offer that.
Interesting. And speaking of those IPOs, there's a study on where all that money they're raising is actually going. Are they really funding all this future growth?
Well, not entirely, and this is an important flag for anyone investing. The study found that only about a quarter, just 25% of the money raised is actually going into capital expenditure, building new factories, buying machinery.
Only a quarter, so where's the other 75% going?
A lot of it is going to debt repayment, funding subsidiaries, just general working capital. So for many of these companies, the IPO is really more about cleaning up the balance sheet than it is about funding some dramatic new expansion.
That definitely puts a different spin on things. On the regulatory side, another big change for foreign investors. Looks like the era of anonymity is over for some.
That's right. The curtain is finally coming down on the secrecy around P-notes or offshore derivative instruments. These were basically a way for faceless foreign investors to get into Indian stocks without registering directly.
So it was an opacity problem.
A huge one. It raised all sorts of concerns about money laundering or market manipulation because you couldn't see the ultimate owner. This change forces transparent reporting, which is a massive step for bringing our markets in line with global standards.
Okay, let's shift to the corporate chessboard. Some big M&A news brewing in the pharma space.
Yeah, Indian drug maker Lupin is in early talks. They're teaming up with private equity giants like TPG and EQT to potentially acquire Vitabiotics, which is the UK's largest nutraceutical company.
So moving beyond just generic drugs into that whole wellness market.
Exactly. It's a clear signal of global ambition.
And we have to talk about this enormous private debt deal. The Shapoorji Pallonji Group is trying to raise a massive euro 25,000 crore.
And what's really fascinating here is the price of that money. For this unrated debt, they're talking about an internal rate of return of somewhere between 14 and 15%.
Wow, a 15% return for a creditor on that scale. What does that one number tell us about the credit market right now?
It tells us two things, really. First, just how expensive capital is for unlisted companies outside of the traditional banking system. And second, it shows the huge risk premium investors are demanding right now. Capital providers are pricing risk very aggressively.
Switching gears to cement. Companies in that sector are sounding pretty optimistic about the second half of the fiscal year.
Their projections are solid. They're seeing high single-digit volume growth already.
Yeah.
And they're basically banking on government spending on infrastructure and the housing market staying strong. They see a clear path for demand.
And in energy, a huge policy shift is coming. India's opening up the nuclear power sector.
It's a really significant step, moving away from the old state monopoly model. But the entire industry is now laser-focused on one big hurdle.
Let me guess. How they'll get paid.
You got it. It's all about tariff determination. The government controls the fuel, so the formula they use to set the power rates will decide whether it's even commercially viable for a private company to get into this very capital-intensive game.
Okay, let's pull back for our global snapshot, starting with more signs of strain from China.
Yeah, the story continues. Factory activity there contracted again in November. That's the 8th straight month. It just underscores these deep, persistent domestic challenges that their stimulus efforts haven't quite fixed yet.
What about monetary policy in the Eurozone?
Things look much calmer there. Inflation is expected to hold steady right around that 2% target, so the European Central Bank is likely to just sit tight in December. No change is expected.
A very different story in the U.S., though, where a political change could shake up the Fed.
Indeed. President Trump has apparently selected his nominee for Fed chair, and the name floating around is Kevin Hassett. This is being read as a very clear signal that the new administration wants deeper interest rate cuts, regardless of what the Fed thinks is appropriate. A real push for a more dovish stance.
And geopolitically, a strange move by Russia in the Caribbean.
A very telling one. Russia is rerouting its civilian flights away from Venezuela and sending them to Cuba instead.
Citing safety concerns.
Right, safety concerns. But this is happening as the U.S. has deployed significant military assets in the Caribbean. It looks like Russia is quietly reassessing how safe it is to operate so close to its Venezuelan ally with such a large U.S. presence nearby.
And to bring all that global risk back home, there's a stark warning for some of India's key export industries.
It comes from a BCG report, and it's aimed squarely at sectors like iron, steel, and aluminum. It says they face growing financial risks because of, well, domestic climate inaction.
So how does inaction at home translate into a risk abroad? What are they exposed to?
They're exposed to things like carbon border adjustments. Basically, it's a tariff that places like the EU or the US can slap on your goods if they're made in a country with weaker climate rules. If Indian companies don't decarbonize, their exports could get much more expensive and less competitive. It makes climate policy a direct business cost.
That makes it very real. Okay, finally, let's turn to our innovation spotlight. We're talking about a critical missing link in India's high-tech manufacturing dream:
This is a huge policy move with long-term implications. The cabinet has just approved a scheme, about 7,280 crore, to promote domestic manufacturing of something called sintered rare earth permanent magnets, or REPMs.
Okay, rare earth permanent magnets. That sounds very technical. Why are they this critical missing link?
Because they are the absolute key to building high-efficiency electric motors. They're the magic ingredient that lets you build a motor that's incredibly powerful, but also much smaller and lighter than traditional ones.
And that combination, powerful, small, light, is non-negotiable for modern tech.
It's crucial for two giant sectors. First, electric vehicles, which need super efficient motors to get the most out of their batteries. And second, semiconductor manufacturing, which relies on high-precision robotics that need these exact kinds of magnets.
So we're currently importing them.
Heavily. So this policy is all about building that capability at home, cutting that foreign dependency, and basically building the hardware foundation for the future economy.
It's the infrastructure you need to build the tech that powers the AI age.
Mm.
And speaking of AI, that demand is fueling another massive boon in data centers.
It is absolutely monumental. India's data center capacity is set to explode from around 1 GBW today all the way up to 9 GBW over the next 5 to 7 years. It just shows that the country isn't just planning for a high-tech future, it's pouring the concrete and building the infrastructure for it right now.
And just before you go, a quick note. This deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most.